So good evening, everybody. Thank you for joining us. I hope you all are having a wonderful start to 2022. And thank you, like I said, for joining us for one of our quarterly updates. And we'll be looking a little bit at all of 2021. You know, we get to do that at the end of the year's quarter end. Please welcome me, Sean Gibbons, in this evening. Sean is one of our certified financial planners, relationship manager. Many of you already know Sean's been with us. Sean, we cracked 15 years yet? Or are we still in 14? Where are we?
I think we're in the 15th year.
He's enjoyed every minute of it. So he's been here. So Sean's going to help me this evening. As always, we do this and our hope is to keep you connected, really inspired, and to feel empowered about the plan that you're on. To really make sure that you understand the choices you're making are really going to help you get to where you're trying to go. And that's really our goal and our purpose for this evening. Our outline is pretty similar to what we always try to do. We're going to give you a firm update, talk to you a little bit about ourselves, some of the things that are going on, some of the new resources that you have access to, some of the new people that have joined us. We're also going to talk about the markets, the review, what went on in 2021. I can't believe we're saying 2021 already is over. Then finally, we're going to talk about, Sean's going to get into some financial solutions to consider, looking at your plan, some things around this time of year that you should be maybe thinking about. And then most importantly, this is about you. We're here to answer your questions. So please, the rules of this game is that you are not, you're all muted, so you can't just speak up. But we do have a chat box and a question box that you can put in any type of question you have. Sean, while I'm talking, is going to be looking at that. So if he sees something, he'll raise his hand. I'll pause. We'll try to answer the question for you. And then when Sean's speaking, I'll do the same thing. We did get a question that already came in today, so we're going to answer that for the person who sent that in. So I think without any further ado, we'll get going. So we'll look at our firm updates. We have a lot of new things and exciting things to talk to you about. One of the things I always want to kind of bring up every, once a year at least, is our portfolio rebalancing. It's one of the most important things that you can do. I'm so excited about it because today with technology, we're extremely disciplined around how we do it. We look at it each quarter. If you're outside the bands that we set up, then you will be looked at for being rebalanced. Doesn't mean you're going to do it every quarter. It just means we review it and make a decision on whether or not you should be rebalanced. Why is it so important? Well, there's four major things that we think is why you do this. Number one, keeps your risk aligned to your goals and where you're trying to be. You don't get your risk too high or too low based on how the markets are doing. It always keeps you aligned to where you're trying to go. Most important thing. Second is there is a potential, not always, but there is a potential that you may sell high and buy low. You may be purchasing, stock market's doing really well. We sell some things to bring your risk level back down. So we sell high and buy low. Opposite happens like during COVID, now it's almost 2 years ago now, it seems crazy, but the market dropped dramatically. What did we do? We sold the bonds that were doing well, bought into the stock market, put you back to where your balance was, and that sold high, bought low. And that's really what you always want to try to do. A third potential is tax loss harvesting. Really important to get it, especially when the market goes down, to take advantage of those moments by grabbing some losses so that we can use them for future gains like we've been doing. We've had a lot of gains over the last couple of years, and many of you are carrying some large losses forward. So it's important to do that as well. And then finally, we always are looking to try to get you into the less expensive funds that we can. So a lot of times we do that during a rebalancing time. There's no cost to you doing that. All just happens is you just get exchanged into something just costs less. It's the same thing. So we're really excited about the rebalancing. And just to give you a heads up, the past quarter, most portfolios that needed to be rebalanced were done on December 30th. And we communicate this today through the TimeScale Financial newsletter because the newsletter has a lot of things in it and we want you to be looking at that. And that went out on January 14th to kind of tell you about that. There weren't a lot of people rebalanced this quarter. It was a very low percentage. But you also get an email from Schwab talking about trades. So you should be well aware of it. If you have any questions, as always, you call us, call your relationship manager, and we'll walk you through those things. So this is a good transition right now because I'm transitioning right into our communication. Taking Measures, the name of our TimeScale Financial newsletter. There's a lot of things in there. We want you to read it for current news, upcoming events, which is really important. We have registration links on there as well, blog posts, and really most importantly is you can get any webinar that we're doing. You can catch the replays later, like this one will be on the next newsletter. So if someone missed this, you want to forward it to a friend. We get that question all the time. Can I forward this to someone? Of course you can, and send it right over. And of course, you have any questions after listening to it weeks from now, please give us a call. You can also look at our viewpoints at our website at timescalefinancial.com. A part of our communication, we're really ramping up our social media channels. We're on LinkedIn at TimeScale Financial, so please visit us there. We're also on Instagram at TimeScale Financial, and then we're also on YouTube at TimeScale Financial. We're going to be trying to push out even more content as we go along, and these are ways that you can follow us as well. And then one of the most exciting things that I was really excited about, I don't know, I don't get out much, so these things get me really excited, is we were able now to have a TimeScale Financial app. You can look at your accounts right on your phone by downloading an app. It's really, what makes it so nice is the app itself, in my opinion, is a much cleaner, easier way to view your accounts. But more importantly, it's the first time we have performance reporting is on this app. So you can look at how your accounts have done at specific times and specific dates. So that is accessible to you, but the only way to get on it is you need to contact your relationship manager, because we got to do some things behind the scenes to set you up. But it's very easy. All we're going to do is do things behind the scene. You download the app. We just send you like a temporary password and you're in and ready to go. So if you want to use that, please let us know and we'll get you set up on it right away. One of my favorite things to talk about is new employees, and we have a new addition as well. So we're excited in the fourth quarter. Please welcome and joining James Higgins. He's our operations coordinator, and Stephen McLaughlin also joined us as an investment operations coordinator. They have been a great additions to the firm. We are now up to 20 employees. So we have been growing pretty rapidly. And also, we've been growing. Kate Kendall, we want to congratulate Kate Kendall. She's a director of operations of human resource and finances here. Back in early December, she had the birth of twin boys, Atlas and Boone. So congratulations. Sometimes that sounds like fireworks to me, but it's actually applause. I know the picture looks really small, but you can see the two boys. And in the middle there, there's the big brother, Knox. So Knox is a big fan of this tonight. So if you're watching Knox, hello. And he's been a good big brother so far. So congratulations to Kate and to James and Stephen for joining our family. So that's it on our updates and what's going on with us. We're still, as an office, we're working in a hybrid situation. We're still available and accessible to you, but our office is only open on Tuesdays and Wednesdays. The rest of the time we are back working from home. Does not mean we won't come in and meet with you in person at the office if you'd like on Monday, Thursday or Friday. It's just if you do come here unannounced, you may find the doors closed on a Monday, Thursday or Friday. So let's get into financial markets. A lot of exciting things happened in 2021. Let's kind of dive into it. Another really positive year. The Dow Jones up over 20, S&P 500 up over 28, and NASDAQ up over 27. Really positive. But if you kind of look at those lines there, you don't have to really know which ones is which, but you can see from about the bottom there of January, February line, it really kind of spikes up into around June, and then it kind of gets a little flat and has a little bit more in December. So why am I pointing that out? Because most of the market gain was in the early half of the year. Not good or bad, but that's just kind of what happened. What also is very interesting is, whoops, I got ahead of myself, sorry. There were 5 stocks that if you had the 5, or the S&P 500 had the 5 of them, that it accounted for 51% of the 28% that the S&P 500 went up. Just 5. That's Microsoft, Google, Apple, NVIDIA, and Tesla. If you don't have those 5, you've missed out on 50% of that growth. Now, we always talk about that. Very hard to pick and choose. That's why we do a lot of work with the indexes. That way we kind of capture it all. Because if you didn't have one of those 5, you probably would have a lot less in the returns. Again, strong market across, pretty much across last in 2021, but really heavily, once again, a few firms are carrying the indexes. And I don't see any questions yet, so I'm going to keep rolling. So some other key themes. In 2021, we had a lot of things that really helped push the market. And what were some of those? I know this seems kind of crazy, but hey, COVID-19 vaccines started really rolling out in 2021, put a lot of positiveness back into the market in the sense that we were going to get back to regular life. Consumers went back out and started spending. And then the Fed also declared that they were going to keep interest rates near zero at the beginning of the year. And that was very positive for the stock market. And those are things that helped it kind of propel itself. There were some things that weren't so positive during the year. We had another contested election. Inflation is really starting to show itself here in the fourth quarter. We'll talk a little bit more about that. We had supply chain issues. You've all seen it in the news, and the pandemic and the new variant, right? So we've almost had, lately we've kind of gone backward a little bit as far as getting back out there and so forth. But even with all these ups and downs, the S&P 500 notched 70 all-time highs in 2021. It's the second most ever in a year. 1995 was the one that had the most, and they had 77 in that year. So we really had a strong market, even with all the ups and downs of all the news. So with this strong stock market, with all the different records that are being broken, let's dive in a little deeper and look at them. Not all records are ones you want to break, but let's look at all the different type of records that went on during the year. I thought it was really fascinating. So like we said, the stock market, the S&P 500 broke their all-time high on December 29th at 4,793. It closed above 4,000 for the first time in April of 2021. So it didn't even take, once it crossed 4,000, almost went 20% beyond that. Dow Jones did a very similar thing, broke the record the same date, it won 36,000. It didn't break 30,000 until November 23rd of 2020. So it broke 30,000 and then, shot right up in 2021. NASDAQ was even more interesting. 16,000 was its all-time high, November 19th of 21, but it closed above 13, 14, 15, 16, all in 2021. So again, big record-breaking year in the stock market. And with all that excitement in the stock market, companies rushed more than ever to do what we call initial public offerings, right? To get out there and try to raise money through the public offerings that they can in the stock market. 2021 saw 980 IPOs, initial public offerings, more than twice the number in 2020 and more than 4 times in 2019. I think I saw a question come through. Somebody just asked, how do you view how the first months of 2020 has progressed for the markets? Recommended actions. So I'm going to answer the first part, and I'm going to answer the second part in a few minutes. So the first part is, how do we view what's going on? Obviously, the stock market in the first couple weeks here of 2022 we're not having a record breaking. We're kind of going in the other direction. Stock market seems to be giving some back. Right now, I think the S&P 500 as of yesterday was just down just about 5%, and probably after today, probably eclipsed 5%, maybe getting close to 6. I didn't get a chance to see the final number. So right now, I think you're seeing a lot of headwinds, that the concerns that we're having in the stock market, some of those other ones we talked about. There's tax concerns. There's a midterm election coming up. Inflation is out there. What I would say is this, again, we don't try to time the market. We don't know what's going to happen. And you're going to see in a couple seconds some more factual information that backs this up. But no matter what some of those headwinds are, you don't know how the markets are going to react to it. Look at COVID as really a great example. If you told me in March of 2020 that we were going to drop like that, we were going to lock down the economy, people weren't going to be leaving their houses, not going to work, and that was going to happen, and that was the way it was all the way through 2020. But you were going to tell me by the end of 2020, the stock market was going to be way up here, I would have told you you're crazy. But that's exactly what happened. So nobody knows how these things are going to happen. So what are we doing to try to react to this? We have an investment committee that's meeting on a regular basis. We meet once every 2 weeks to review what's going on. We have consultants and other resources that we work with to try to make sure that our asset allocations are in the right place. We have been positioned to handle inflation for quite a long time. What I mean by that is we have been doing shorter on duration. So when inflation comes, you can think of it like a CD is probably the easiest way to think of it. You know, a 1 year CD, like a 3 year CD may be giving you 1.5%. I'm making up a number, excuse me. And a 5 year CD may be 1.75. So the argument is to lock up your money for that extra 2 years probably isn't beneficial for you. So what we try to do is get a little shorter on what we call the duration and bring them in. So same thing with bonds. We're trying to make our bonds a little bit shorter. Again, not putting all our eggs in one basket because we don't know what's going to happen, but we're putting ourselves in those positions to try to make sure we're aware of the environment in front of us. But again, we're not making majorly dramatic moves. We're not trying to time the market because no one knows exactly what's going to happen. And as we continue through this, I think you'll even see more evidence of that. So hopefully I answered that question for that person. Thank you for asking, by the way. So back to the initial public offerings, really tremendous amount of records there. A record 19 companies raised more than $1 billion on their initial public offering. Huge amounts of money. And in total, $1+ trillion was raised on these initial public offerings on the direct listings this year. And you can see some of the notable names with Diddy, Bumble, some of the other platforms like Robinhood and Coinbase were there. So really, really big numbers. I wanted just to mention this really quickly. I think we've kind of gotten lost on what $1 trillion is and how big it is. If you were to count, one number is 1 second. So if I say 1, that's 1 second. 2 is 2 seconds. And you were going to count like that all the way up to 1 million. It would take you 11 days, just over 11 days to count to 1 million. If you were going to count to 1 billion like that, it would be 31.7 years to count to 1 billion. So 31 years plus for you to count to 1 billion. To count to 1 trillion is 31,709 plus years for you just to count to 1 trillion. That's how massive 1 trillion is. And I think we're really losing sight of that a little bit because we throw out trillions of dollars like it's no big deal. But it is a massive number. So these are really big, big numbers. So some other breaking things, so everyone was rushing to issue equity and stock and do IPOs. Well, the bond market got just as involved too. High yield bond issuance hit a record high of $43 billion in 2021. As people were hurrying to borrow money at relatively cheap rates for investors as inflation started to take hold. We also saw, mergers and acquisitions were also abundant. Businesses were combining, and private equity deals amounted to over 40,000 transactions with an aggregate value of more than $6 trillion, back to our trillion. That would take you 180 years to count that 6 trillion out. So big, 180,000 years, sorry. Big numbers. Part of the reason for this surge is in deal making was attributed to people trying to play catch up as prior years mergers and acquisitions were muted because of COVID. And there was also about 3.6 trillion worth of deals completed in 2020. So you can see almost double was done in 21. Some other record-breaking year is inflation. Consumer price index. So maybe not something we all really want. It costs us more. Inflation, really is the concept of, what we go out and buy with our dollar. Now we can only buy less stuff. So it's our purchasing power. Consumers began buying again in spring of 2021. And as they did, prices began to tick up. Supply, demand for things were really starting to pick up as consumers got back out there to spend. A lot of this is attributed, like I was saying, because of COVID, we were held back. At the same time, while all this was going on, shipping costs and snarled up ports around the world caused further price increases along with delayed and freight supply chains. So because demand picked up, there wasn't as much supply. It's an economics class. Demand's high, supply's low, prices go up because they kind of got us, right? There's not as much stuff out there. One thing that we saw, the consumer price index saw a rise of 6.8% in a 12-month period ending in November of 21. It was a rate that we've not seen since the early 80s. So this could be, I've been saying that inflation is going to come for 15 years, and I may finally be right. I don't want to be right necessarily, but it looks like it may be here, or already is here, frankly. Core inflation, the CPI index that we're looking at, does not include food and energy. So, which are probably the things that we consume the most as individuals. Gas prices, I tried to get some numbers for you. Gas prices were up 58.7% from November 21st versus November 20, from November of 2021 versus November of 2020. I tried to get you some food numbers. Unfortunately, food is kind of all over the map, so it was a little bit hard to give you something that didn't seem too skewed one way or the other. But the point is, we all go in the grocery store. We know things have gone up. And it's not included in that CPI of 6.8. If we included food and energy, it would be a lot higher, obviously. So another record-breaking home prices, right? We've anyone who's trying to buy a home, or if you sold your home, many of the people we work with sold their homes and took advantage of this. July posted a 19.7 year-over-year increase on the price of someone's home. Prior to 2005 housing bubble, the prior year record year-over-year was 14.5. So this thing blew it away, one of the highest year-over-years of all time. The Chase-Shiller Home Price Index that measures the average price of homes in the U.S. hit a fresh record high level of 271.2 in September of 2021. All that really means is prices of houses are high, all-time record highs. So not great if you're trying to buy a house. Car prices, I think a lot of us have been through this, right? Used cars, if you're trying to buy, used cars are getting more expensive or had a higher premium on it than new cars did. And if that's assuming you can find a new car. In September of 21, the average price for a new car in the US topped $45,000 according to the Kelley Blue Book, and more than a 12% increase from the same period in 2020. In September of 21, the average price of the US for a pre-owned vehicle jumped nearly 25% to an average price of $25,000 and change. So really high cost of expenses in homes and cars. And look, we're not done yet, right? The record-breaking year continued. Cryptocurrency's total value hit almost $3 trillion in November of 2021. We have seen that come down, just like we were talking about with the stock market. But Bitcoin remains the most valuable of all cryptocurrencies, dominating the market at 40%. It actually retreated from its high of 64,000, as I just said, and prices soared just under 68,500 in November before it pulled back. Today, it's in the low 40,000. So it's a very volatile space. Many of you have asked us why we're not getting in, we're not adding into our asset class, and it's for that reason alone. Very volatile, more volatile than we need in what we're trying to do when it comes to your serious money. Listen, I got nothing against people investing in Bitcoin. I always tell you to be careful, but that should be in your Vegas account to the side. Your serious money should be doing asset allocation. And if you want to have a little Vegas account, there's nothing wrong with that. November of 21 also saw Ether, the token of the Ethereum blockchain, hit a record of 4,850, and it commanded more than 1/5 of the entire crypto market capitalization. So now it's 1/5, 20% of the overall market. There are several others out there. They all also soared. You've seen some of the names before: Dogecoin, Shiba, and I won't get all those, but everyone's set a record pace in 2021. This is one that's also probably not a positive, but the debt ceiling of the government. October of 2021, Congress voted to increase the debt ceiling limit to 28 trillion, 28.9 trillion. If 1 trillion was 31 years, 31,000 years, I'm sorry, 28 trillion, we're in another stratosphere. We wouldn't be able to count that for many lifetimes. So another record that was broken. So what's the punchline of all this? Some positive records with the stock market, pricing, and a lot of records that not so positive. What does all this mean? It means stick to your plan. Like the question that the person just asked us, with the market going down now, should we panic? Should we do this? No, stick to the asset allocation. Many people have come to us and said we should have got out during COVID. Good thing we didn't. Many people came to us and said we should have got out before the election when Trump got elected. Good thing we didn't. Again, not being political, but we don't know how markets are going to react to certain things. Don't let volatility, speculation, certainly not the headlines, derail you from your plan. Remember, a lot of times when you're listening to the media, it's a short-term scenario, what they're talking about. They're not looking at the long-term. We are looking at the long-term for you. And if many of you are sitting out there saying to me, oh, wait a minute, I don't have a long-term. Yes, you do. Now, you're going to be here a long time. And even if you are retired, we hope you're having a nice, long, happy retirement. So you are going to be here. So stick to that plan. So any other questions come through? No, I don't think so. So I'm going to turn this over to Sean. I'm going to try to do Sean. I'm going to do the best I can at doing the slides for you. So I'm going to turn it over to you, Sean. Go ahead.
All right. Thanks, Jim. Great job. So I'm going to be talking about our empowered approach to financial planning. And it really all starts with your goals. Okay. Because it is all about you. What are your goals? Is it retirement? Is it saving college for kids? Is it passing on assets to your heirs? We basically want to first define your goals. And then what we really talk about is having a process and wrapping that process around your goals to make sure you're on track and achieving them. So when it comes to our financial planning approach, there are two phases. The first phase is to coordinate and consolidate your assets, and that's having your money make money in the most effective way. And there are three segments. There's spending, which is all about your budget, the income coming in, the expenses going out, which you do day in, day out. The second segment is savings, where we talk about having an emergency fund for unexpected expenses, managing your debt properly or even eliminating it, as well as saving for educational expenses. And then finally, investing is where you take on risk with long-term goals, like such as retirement, to make sure you're making money in the most effective way. So once that's all coordinated and consolidated, we go into phase number 2, which we want to protect and conserve everything we've done in phase 1. And that's where tax planning comes into play, where we want to minimize the tax bite of Uncle Sam. Risk management is a fancy word for insurance, making sure you have protection of all your assets. And then finally, estate plan. This is where, the wills, trusts, health proxy, power of attorneys come in. Just God forbid, if you pass away, that the assets go to your loved ones. Okay. So once we have this all in place, again, it's all about you. It's all about your goals and making sure those are on track. And in the end, it's about measuring what matters to you, because that's going to be different to each and every one of you. And we want to make sure we have a process in place to make sure that happens. All right, so it's January 2022. So financial planning solutions to consider. Great time of the year to talk about this stuff. First is understanding your goals. You want to prioritize them and want to make sure you understand what you want and why, and has anything changed. So that's always the starting point. And then when we get into spending, it's the money you spend every day. We always want to monitor the budget, and we want to always, if you're not retired, aspire to increase your surplus. And then in January, it's always a great time, when we talk about the COVID budget, maybe you haven't been spending money and your emergency fund has increased because there hasn't been much lately to do in the last year or 2 years. So maybe take that excess cash and allocate that more efficiently to your emergency fund, or paying down debt, or maybe saving for retirement or educational expenses for the kids. Savings is the money you set aside for upcoming expenses. You obviously always want to have an emergency fund, typically 3 to 6 months of your expenses, but there's no right or wrong answer when it comes to that. It's whatever makes you feel comfortable sleeping at night. We do recommend establishing a home equity line of credit on the house. Doesn't mean you have to use it. It's just the backup to your plan. And then obviously pay off credit cards. It's right after the holiday season. Maybe the credit card's a little higher than you think it is. You want to pay that off because obviously the interest rates, it's like loan sharking. They can charge up to 30% interest. So we want to eliminate those as quickly as possible. And then maybe it's also bonus or raise time. So maybe you got, 3 or 4% bonus, 3 or 4% raise, maybe increase savings or contributions to, the 529 plan for college, or, retirement, or paying down the debt. On the investing side, this is obviously where you take on risk for long-term goals, such as retirement. Obviously, you always want to make sure your goals and time horizons are aligned with your portfolio. And then, do we need to rebalance? Obviously, that's a conversation you're probably continually having with your relationship manager. And then always remind yourself, as Jim had mentioned, avoid the noise, okay? Especially the news and the headlines. You could drive yourself crazy. Always need to stay the course is the best advice that we can always give you. And then some things to consider is that the retirement limits by the IRS, they've actually been increased if you have a 401k or 403b plan at work. If you're under 50 years old, you can save an extra $500 at $20,500. And then if you're 50 and older, you can save $27,000. So make sure you're maximizing those as well. Tax planning. Obviously, we want to minimize the tax bite of Uncle Sam. It always starts, know what your rate is. Effective rate is always good to know. whether you're in the accumulation stage, you're still working, making sure you're accumulating money in the most tax efficient way, or maybe you're in retirement, putting together a proper tax distribution strategy when you're retired. And then obviously collect all your tax forms, make sure you have all your 1099s for your accountant, or if you do your taxes on your own. And then if you do itemize your taxes, don't miss out on any deductions. And then risk management, big word for insurance. Obviously, you want to protect what matters most to you. One thing that we've been chatting about is make sure your homeowner's policy is up to speed, up to snuff, specifically when it comes to replacement costs. Housing values, as Jim has mentioned, just raised 19% just last year alone. So you want to make sure, God forbid, if there's a fire or a catastrophic event in your home, that the replacement coverage is up to speed. Also, building costs have soared, so you want to make sure that number is up to date. So definitely check on that. And then the estate planning. Obviously, you always want to have an estate plan. I'd always say review it every 3 or 4 years to ensure it matches your current goals and wishes. Make sure estate planning laws do change over time, so you always want to review it over time. And then if you don't have an estate plan, maybe put that on your 2022 list of to-dos. Okay. And that'll be a good New Year's resolution for everyone.
Awesome. Thank you, Sean. A lot of good points and things to be thinking about there. Obviously, everything starts with your goals. It sounds so simple, but many times we hear people that think they know where they're going, but they don't really have it clearly defined. We got to manage that holiday debt. We know we all get a little carried away buying gifts and loved ones. So if you are in debt, we want to make sure we take care of those things. Increase any systematic contributions. If you're getting raises and so forth, get savings going up. Keep your 401k contributions going up with the increases. Prepare for tax season, as we said. Expect the 1099s from Schwab to come out mid-February-ish. We'll let you know. They usually try to do about a 15th, but you never know how things go each year. And then we talk about that home replacement coverage. That's a really big deal. A lot of people's values have changed, as Sean has just described. And New Year's resolution, we try to do this with everybody all the time. Make sure we update those estate plans or get them done if we can. So a quick summary on that stuff, and really great. Hopefully there's maybe something there kind of clicked for you and helped you out. Maybe reminded you of some things you want to make sure you take care of. Again, any questions or thoughts, please contact your relationship managers. Questions now. We did have a question that came in, and I kind of said it's a little bit similar to the first question we had, but the Fed has indicated that it will begin to raise interest rates, which isn't good for stocks. Should I sell? First, the person's correct. The reason why it's considered not good for stocks when interest rates go up is the idea that prices are going up, so that it hurts the company's earnings, right? If it costs more for them to produce something and they're selling it, in theory, their margin is being shrunk. And that's bad for earnings, which means in theory, it's bad for their stock price, because their stock price is driven by how much money they're making, how much earnings they have. So the question is, should we be making a change because of this inflationary factor? And my answer to you is going to be very similar to what I said before, but this is where I said I have a little bit more factual stuff to show you. We don't know what's going to happen. We don't actually, first of all, don't even know if inflation is going to happen, or if they're going to raise rates. They say they're going to, but a lot of times they change their mind. So we don't know. But if they do, is it necessarily bad for the market? I know this is a little fuzzy because I had to cut and paste this out of something. But when the Fed is raising rates, generally that's at a very positive time in the stock market. So what I did is I took this out of Market Watch at CBS. That's where I got the information from. So it says during a Fed rate hike period, so during a period where they're going to raise rates, the average return for the Dow Jones Industrial Average is nearly 55%. The average return for the S&P 500 is 62%, and the NASDAQ is over 100, basically doubles. So when they say a rate hike period, so that's just when the Fed is going to be increasing. So you can look at these different time frames. Only one time frame did the markets go negative, and that was in June of 1999 to January 2nd of 2001. So, a couple of years there that they were raising rates, and the markets actually did, basically flat, a little down. But all the other periods over the last 30 years, they've all been very positive reactions to rate hikes. So again, we sit there and say rate hikes are bad for the stock market, but yet look what happens. And again, part of the reason is rate hikes are happening during a very positive economy. So if the companies continue to do well, sometimes they can absorb the price inflation effects because they're basically passing it on to consumers, or again, the economy is strong, so they're selling more in volume to make up for that price increase. So again, we can't try to go out and make decisions or make pivots just because of what we hear on the news or just because of what we think may happen. We just don't know. And a lot of times it goes in a different direction. We have a question that came in. I have most of my retirement savings in a 403B IRA. I need more tax-free income for future retirement. Looks like the backdoor Roth still an option. Tell me more. Okay, so yes, we do agree with you. First of all, the issue that this person is describing is a very real one. Many of us put a lot of effort, first of all, when we first start out in the 401ks. And for many of us, sadly, who are a lot older, we didn't have a Roth option. So we went right into traditional 401ks and 403bs. So all that meant was we got a tax deduction today, we got tax-free growth, and then when we get to retirement, every time we take money out, we're taxed. So the problem is if all you ever did is save into these traditional 403bs or IRAs, when all your assets are tied up in these, when we get to retirement, we're kind of handcuffed to the tax code. What that means is because all we have is access to this account that we have to pay tax to. So let's say we want to live on 100,000 and it's we need to take out 130 to net 100. That may be fine. But if we need to go buy a car or something and we need to pull out 30,000 for a car, and today the average cost is 45,000, we may jump ourselves to another tax bracket and have to pay more tax. So that's what I mean by being handcuffed. What this person is asking is a really good question, saying, hey, look, I know I don't want to be in that handcuff situation, so I want to get an outside account like a Roth, because what a Roth does is you pay taxes today, the money grows tax-free, and when you get to retirement, it comes out tax-free. So it gives us a place to pull money out, not have to pay tax. So the question is, the backdoor Roth is still available. Yes, it's on the table to be taken away in 2022, though, so be very careful. If we try to do this in 2022, we may get kind of tricked and may have to reverse it back out. But what is a backdoor Roth before I even get into that? A backdoor Roth is the idea. So for many people, you can't do a Roth because there's a salary limitation. So if you make too much money, you can't even do a Roth. But there's a backdoor way to get into it. And the way to do that is you can do what's called a non-traditional IRA, which just means you're going to put money into an IRA, but you don't get the tax deduction like a traditional one. So you won't get the tax deduction. The money goes in, grows tax deferred. And when you get out the other side, in theory, you only pay tax on the growth of the money, not on what you originally put in. But to do a backdoor Roth, if you put money into a non-traditional IRA, a non-deductible IRA, you can then put the money in and then convert it to a Roth because you've already paid the tax. And when you convert it to the Roth, in theory, you would have to pay tax, but you already paid it. So you move right over to a Roth, you don't have to pay it. So yes, you can do that. The only problem is this, and this gentleman, Dan, I see that you mentioned that you have an IRA. A backdoor Roth, so when you put money into that non-traditional IRA, and let's say you want to move 100% of it into a Roth, you take that, so you're going to put in the $6,000 or $7,000 into that non-deductible IRA, and you want to turn it into a Roth. 100% of that money is going to move. Any other IRA that you have to move the same proportion to a Roth, and that's the problem. So if you have 500,000 in an IRA somewhere, and you just did that backdoor Roth, they want 500,000 to go into the IRA, and you got to pay tax on that 500,000. So a backdoor Roth only works for people who don't have other IRAs. You can have 403Bs, that's different. But if you have other IRAs, it doesn't work. So you have to be really careful using a backdoor Roth. What I would suggest, and it may not be an option for you, but we should look into, and maybe you already have, that at your company, do they provide what's called a Roth 403B or a Roth 401k? A Roth 403B or a Roth 401k does the exact same thing as that. It allows you to get into a Roth, but there's no salary limitation. So instead of putting into the traditional 403B or the traditional 401k, you can convert all of your money up to the new limits that Sean was just talking about, 20,500 if you're under 50 or 27,000 if you're over 50. You can have all of that go to a Roth 403B. It doesn't cost your company anything to put it in. So if you find out that your organization doesn't have it, maybe talk to there's usually the investment committee or something, see if they can get it added for you, because it's really great and it costs them nothing. So that would be a better option. Not only is it a better option because we don't have to worry about your other IRAs and that problem, but more importantly, we can put more money in. So Dan, I would definitely say, speak to your relationship manager about that, because I agree with you. It's very important. And it was really a great question. So thank you for asking. Hopefully I answered it well for you. Longer than you probably wanted. Back to, oh, I just went too far. So we're talking about questions. I got to go back. I'm sorry. Oh, now I'm really in trouble. Sean, I'm messing it all up. I'm going the wrong way. Sorry. I just wanted to finish off the thought on this question. You know, many times when we talk about, you know, we hear about things that are bad for the stock market, taxes, all these headwinds that come at you. You just don't know how the stock market's going to react. And I just thought that this person asked me a really good question, and I went and found this because this is what does happen sometimes. So we just can't try to predict or time or guess what the market's going to do. What's important is to keep your risk level at the right spot, stick to our plan. And I'm telling you, the rebalancing is the key. And making sure your risk level is at the right spot too, because if you're close to retirement, we don't want to be in 100% stock market, because if it tanks, we have to have flexibility. If you're super young, yeah, we can take on that aggressiveness. And if you're in the middle there somewhere, we'll figure out the middle. But that's what's most important to do here. So I don't see any other questions. I want to thank you guys as always for taking out an evening to be with us. Feel free to send in any other questions if we didn't answer something for you. Also, I hope this kept you connected and you feel more inspired and more empowered to continue the things that we're already doing for you and to continue the choices you're making as far as your savings toward your financial goals and so forth. And then I always have to show the disclosure side. But thank you guys, as always. If there's anything we can do for you, please let us know. We're so humbled to be a part of this with you and help you reach those financial successes. Sean, thanks for joining us, helping me tonight. And I hope everyone has a wonderful night and a great start to 2022. Stay healthy and be well.
Thanks, Jim. Have a great 2022, everyone.